Hello, everyone. My name is Aadi,
And my name is Nishant.
and together we're presenting our stock pitch on Capital One Financial Corporation, ticker COF, on behalf of Carrollwood Day School's Young Investors Society.
As of February 16th, 2026, Capital One trades at $205.06 per share. Our recommendation is a buy to hold with a 12 to 24 month price target of $260, representing approximately 25% upside. Let's walk you through the reasons why.
Founded in 1988 by Richard Fairbank and Nigel Morris, Capital One began as a credit card specialist. What set it apart from day one was its information-based strategy, a strategy where data and analytics should drive lending decisions.
Today, it's one of the largest technology-focused banks in the United States, with approximately 53,000 employees and trailing 12-month revenues of $62.74 billion, operating across credit cards, consumer banking, and commercial banking segments. Our investment thesis rests on four pillars. The first is vertical integration. In May of 2025, Capital One completed its $35.3 billion acquisition of Discover Financial Services. Capital One is now the only major bank operating as an issuer, a bank, and a payment network simultaneously, capturing economics at every layer of a transaction. Most competitors pay that out to Visa and MasterCard. Management projects $2.7 billion in annual synergies by 2027, with the deal supposedly being 15% accretive to adjusted EPS by that same year.
Second, AI and data-driven underwriting. Capital One is 100% cloud native, employs thousands of data scientists, and deploys machine learning models assessing over 100 behavioral variables per applicant.
Third, payment and monetization tailwinds. The structural global shift from cash to digital payments benefits Capital One.
And fourth, strong and improving financials. Revenue is up 64% over 3 years, free cash flow has nearly doubled, and net interest margins have risen over 8%.
Here's some of the headline numbers. Capital One is the #1 credit card issuer in the United States by outstanding loan balances, with 19% market share. Trailing 12-month revenue is up 17% year over year. CET1 capital ratio of 14.4%, which is well above capital requirements, which enhances deployment flexibility. The stock has also consistently outperformed the iShares US Financial Services ETF over a large period shown in the graph above.
Capital One competes across 3 markets, all with favorable growth dynamics. We are seeing steady growth across all 3 segments, specifically driven by mobile adaptation and the digitization of B2B payments. U.S. revolving credit outstanding exceeds $1.3 trillion. Post-Discovery, Capital One holds 19% of outstanding balances, the largest share of any issuer.
Over 80% of consumer transactions are now mobile. Capital One's phygital model, or physical digital, a top-rated app combined with 50 Capital One cafes, gives it a structural cost advantage over legacy branch-heavy banks, supporting a sticky deposit base of $475 billion and positioning it as the 6th largest insured depository in the United States.
Capital One focuses on high-value niches in commercial banking, an $88.4 billion portfolio in healthcare and multifamily real estate, while the Brex acquisition opens the door to $124 billion global B2B payments market, which is finally moving digital.
To assess Capital One's durability as an investment, we ran a full Porter's 5 Forces analysis. Bargaining power of customers is rated a low threat. Capital One rewards are non-transferable, and the more embedded a customer is across Capital One's full ecosystem, the harder it is to leave. Capital One also provides a structurally cheaper option for subprime and near-prime borrowers.
Intensity of competitive rivalry is rated moderate. Capital One is spending roughly 41% more year over year on marketing to compete for premium cardholders. What differentiates Capital One is its positioning across the full credit spectrum, serving subprime borrowers while simultaneously competing with Amex Platinum through VentureX.
Bargaining power of suppliers is rated insignificant. Capital One built its own proprietary cloud-native stack from scratch, eliminating the need for external vendors. By acquiring Discover, it also removed reliance on the Visa MasterCard duopoly entirely. With $475 billion in consumer deposits, it's also not dependent on wholesale funding.
Threat of substitutes is rated low. Buy now, pay later platforms such as Affirm or Klarna are appealing fintech competitors, but credit cards offer fraud protection, purchase insurance, rewards, and credit building that buy now, pay later cannot bundle effectively today.
Threat of new entrants is rated low. Post-2008 banking regulation creates a moat. Fintechs that tried to disrupt lending have largely been forced to partner rather than replace chartered banks. Even Apple has reportedly wound down Apple Card. To replicate Capital One, a new entrant would need decades of proprietary credit data, a global payment network, and a $475 billion deposit base, and would have to pass through many government hurdles.
The Financials tell a story of a company investing heavily in its future from a strong foundation. On revenue and profitability, total revenue grew a 64% increase from 2022 to TTM. Net interest margins reached 8.26% in quarter four 2025, reflecting strong pricing power.
On cash flow and growth, operating cash and free cash flow nearly doubled, and total equity grew from 52.6 billion to 60.78 billion, demonstrating consistent book value accretion even during periods of heavy investment. One critical thing to note on margin was that recent earnings compressions are primarily driven by a near quadrupling of loan loss provisions. This could easily reverse and appear as a capital expenditure or realized gain if economic conditions stabilize.
For valuation, we used a free cash flow to equity discounted cash flow model for Capital One because for banks, debt and deposits are part of the operation. So valuing equity cash flows directly is the only accurate approach. But why use 2021 to 2024 average net income and not 2025? This is due to Capital One's large acquisition of Discover in mid-2025 and ongoing integration costs. The net income statements are skewed. Thus, to combat this, we took the average of the preceding years for our calculation. Our cost of equity is 11.1%, derived from the capital asset pricing model, using a 4.2% risk-free rate for the 10-year treasury, a beta of 1.15, and a 6% historical equity risk premium. Discounting those cash flows and adding the present value to the terminal value, we arrived at an implied share price of $260.
Here are some of the key risks we analyzed when developing a case for Capital One. The first is the macroeconomic risk. Capital One carries a high concentration of near-prime and subprime borrowers. In a softening labor market, these borrowers default first. An unexpected economic shock could spike charge-offs well beyond current reserve levels. The bank's AI underwriting and recent buildup of loan loss has historically priced these risks accurately, but no model is fully recession-proof.
Integration risk. Capital One is simultaneously integrating two major deals, the Discover merger and the Brex acquisition. Merging Discover is complex, and outage during the merge could cause serious reputational damage. And the promised 2.7 billion in synergies may also take longer to materialize than currently expected.
There's also a regulatory risk. With assets approaching nearly 700 billion, Capital One has entered Category 2 regulatory status, meaning stricter Federal Reserve stress testing and potentially higher capital buffers under Basel III.
Cyber risk. The 2019 data breach is a relevant historical reference. AI-enabled cybersecurity platforms are being deployed to mitigate the cyber risks.
Here's a little bit about Capital One's environmental, social, and governance initiatives. Environmentally, Capital One uses 100% renewable energy for its operations, and all new construction meets LEED silver standards. Socially, Capital One has recently launched the $265 billion Community Benefits Plan. Capital One consistently provides free money and life programming at in-person Capital One cafes and free digital credit building tools like CreditWise. Not to mention Capital One's exceptional workforce diversity across gender and race at all levels. On the governance end, Capital One's board is overwhelmingly independent, with 14 of 15 board members being non-executives. Overall, Capital One is ranked highly in the 85th percentile for ESG considerations, according to CSR Hub.
AI. In the rapid evolving world of AI, Capital One's technological advantage becomes very clear. Capital One embedded analytics into credit decisions decades before peers, and today it's the only major bank that is 100% cloud native with no legacy data centers. This enables rapid AI deployment across every dimension of the business, whether it be real-time fraud detection, customer service automation, or personalized marketing optimization.
The January 2026 Brex FinTech acquisition extends this into the B2B payments market, bringing in zero-touch expense reporting, real-time policy enforcement, and AI-driven spend management software in a higher multiple market where JP Morgan and American Express have historically failed.
Critically, this creates a cycle. Over 180 million accounts generate billions of annual transactions, which feed models that continuously improve, thus attracting more customers.
To bring it all together, Capital One is a fundamentally unique company. The Discover acquisition has made it the only major bank in the world that is simultaneously an issuer, a bank, and a payment network. Its AI infrastructure creates an underwriting edge that compounds over time, creating high lending margin opportunities.
The general shift to digital payment and lending supports Capital One's offering across commercial and consumer markets. Its financials are strong, its cash generation is exceptional, and at a $205 per share, the market is not yet fully priced in these advantages. Our recommendation, buy with a 12 to 24-month price target of $260, approximately a 25% upside from current levels.
Thank you.